The real estate market often seems like a distant world where only an elite of experts is successful. In a time of so much uncertainty in the air and bad news, real estate investing can seem intimidating. But today, I want to tell you that if you make the right decision today, you can enter the real estate market from the back door. Bad credit record? No credit at all? Do you dread the idea of having a home loan? Do you dream of owning investment properties? You are in the right place and right time, because we have created a program which is a tax lien and deed investment online course of only 14 hours. This course is specially designed for people like you who have big dreams. You will learn at your own pace and everything from your home computer. This is your chance. Join our membership for $19.99 a year. What are you waiting for? Visit our website primetimehomebuyerBuyback.org and sign up today for course access.
Thank you, Jesus. Thank you, Jesus. I just started talking, and then I saw the mic was mute. Blessings, blessings. Welcome, welcome to Primetime Home Buyers. I might as well just do the whole introductory again. All right, welcome to Primetime Home Buyers. You're here with your host, Lashley, your tax lien expert, and you know how we do on Mondays, some Wednesdays, and some Fridays, where we give you a host of information pertaining to tax liens, tax deeds, as well as we have our Secure Your Energy session. So in honor of our Secure Your Energy session, I have incorporated understanding business taxes, but I do want this to fall under primetime home buyers section because you know a lot of people who invest in tax liens and tax deeds actually do it under LLCs and businesses for tax purposes as well as to separate liabilities. So we went over that last week and I want to continue that conversation today. You know, tax season is almost coming to an end on April 15th. And guys, I am so glad I caught myself because y'all know I start talking and then it be on mute. So God be the glory. I was like, all right. So if y'all ready, it's going to be no more delay because this actual PowerPoint is pretty long. So like I said, this is going to be up here for keeps. I'm not going to take it down. This is not part of the charge program. This actually falls under our member section in the Secure Your Energy. But I'm going to put it in a particular area that the people who are in the program on the website, they'll be able to look at this, okay? Because this is very important when it comes to entity establishment, representing yourself correctly in commerce, and understanding tax liability. And that's something that you don't want to understand later on. You want to establish that in the beginning. As we say, do your due diligence will save you a host of issues. So let's see if I can get this PowerPoint on the screen. Let's cross our fingers. I did a double, triple edit. So if it's any typos, you know what I'm gonna do. I'm gonna fix it. Anyway, y'all know I'm so OCD. I can't help it. Let's get it on the board. Let's get up there. Hold on a second. And I'm gonna put myself little on the screen. Because I like to kind of keep it interactive, but I don't want to distract y'all from the actual content. Okay. So let me just get things set up for you. Let me see. Give me 1 second, guys. I'm gonna take the presentation off. I want to see, can I add another layout? They say you're gonna create a layout. Yes, I am. Let me create a layout so everything could be nice and clear for you guys, and then I can be in the corner and not be in the way. All right. Okay. Oh, I was about to make myself really big on the screen. I know y'all don't want to see my big head. Y'all want to see the PowerPoint. Give me 1 second. I'm doing a little producing here. Okay. I think I got it. Yeah, I like this one. You see, I put myself in the corner. Now this is the PowerPoint. As I say, get your pen and papers ready. This is we're gonna give you a lot of, I'm gonna give you a lot of information today, okay? All right. Primetime home buyers filing business taxes. What you should know. Now, this is part two. If you missed part one, please check out last week's live. So, we're going to get into these particular topics on this live: filing business taxes, what you should know, LLC, tax benefits and liabilities. We're going to do a little overview. We talked about that last week, but we went more than just LLC. Okay, we went into corporations. What's the F corp versus the C corp? How do you elect to do that? We're going to get back into that today. What is a sole proprietorship? I do apologize. Sole proprietorship versus an individual owned business. Now you're going to understand the tax liability between according to each entity. Okay, and we're going to make it make sense. And we also have resources for you at the end of the PowerPoint, and I'm going to put it at the bottom of the description. Okay. We're going to get into hobbies versus business. This is something you need to consider. Federal and state taxes. What are the type of taxes business pay? When do I need to file small business taxes? Excuse me. Good record keeping. I'm going to have to get comfortable, guys. Business expenses and deductions. And the last part is going to be estate taxes, but that's going to actually be part three because there's a lot of information that goes with understanding estate taxes, and we're going to have a few more other subjects with that particular subject. Okay, so let's get to it. LLC, tax benefits and liabilities overview. So it's a short overview. Limited liability company taxes, single member LLC. The way they're taxed, LLC use pass-through taxes through the owner's tax return. This is done by following a Schedule C Form 1040. I'm going to tell you, there's going to be a lot of information here, so just take your time, and I'm just going to read through it slowly, okay? So I'm just getting right through it. If you have a single member LLC, you're going to be taxed using pass-through taxes, and I'm going to give you more details of what that is. Now, if you have a partnership, each member, a partner, must file a separate tax return on their personal tax return, okay? And the same thing with a single member LLC. Your taxes is filed on your personal tax return. So I want you to remember that because it's going to be a difference when we talk about corporations. So partnership, each member of the partner must file a separate tax return on their personal taxes. They must use the LLC form 1065. Know that this is located on the IRS website, as well as, don't stress yourself, if you use TurboTaxes, these forms actually generate for you when you give them a good description of what you're doing, okay? The IRS reviews the 1065 to see if their reported income is correct. Now, if your partner reports income and you report income from that business that's not correct, that's where they're going to find a discrepancy. If the partner has shareholders or have shares in the business profit or loss, they also must file a K1 IRS form. So if you do have profits, you do have to report that to the IRS, and they do tax you depending on how much it is, okay? This form is used to report the profit and loss information highlighted on the individual's 1040 form. So this is on that 1040 form. I know 1040 sounds very familiar. That is the first forms that you see actually on your tax returns when you get the whole printout, okay? So just look at that. Each form has a title. So it is a Schedule C, Schedule D, Schedule J, Form 1040. So just look at the top right hand corner or the bottom right hand, no, top left hand corner. I do apologize, or the bottom right hand corner, so you can identify these pages. If you're having any issues, especially if you're reading these financial documents off to somebody or you're using them to fill things out like, kids financial aid or loan documents, they ask you to go to Form 1040s, line 16, and put that information in. I'm just kind of giving you an abstract explanation so you can understand where this applies at. So this form is used to report profit and loss information highlighted on their individual 1040 form. So remember, it's on your individual personal taxes. You're going to report your business information for a single member or a partnership. Okay. Limited liabilities continues. Now going under corporation. To have a valid corporation entity, I'm just going, this is an overview. To have a valid corporation entity, you must file Form 8835. This is for the entity to elect to be classified as a corporation. LLCs can choose to be an S Corp or C Corp. And a C Corp is actually a corporation, as two different types of corporations. We went over that. The S Corps, it limits the number of the shareholders you can get. The C Corps does not. It's different tax liabilities, but it's pretty similar. It's very strict. You have to document very well. Anything, you have to have minutes. You have to have board members. All of this have to be documented. So if you do not remember that, please go to last week's video, okay? All right, continue. LLC tax benefits and liabilities overview. The benefits of having a limited liability company. Again, tax flexibility. When having a limited liability company, that's why many people, individuals, actually choose it. It's the tax flexibility. What does that mean? This is when we talk about the pass-through taxes, because when we go into having a corporation, corporations are usually double taxed. Okay, so the reason why I find this very important to go over this information as well, because I did find a particular video that was going viral at one point on TikTok about someone, talking about the importance of having a corporation and the tax benefits of it. But they were leaving out the important parts of what you have to do to be legally considered a corporation. So if you guys remember that, it was kind of trending about 6-7 months ago, and people were opting to have a corporation and did not know the extent of the documentation and record keeping you had to keep. But what that goes to say, LLC, you do have to keep records, and you do have to do your due diligence, but you don't have to go through the extent you'll have to do if you have a corporation, okay, where you have board members and you have to report minutes and all of the things that we mentioned before. So you get a tax flexibility with the LLC company. No double taxation, as what we talked about, if a business is taxed as a sole proprietorship or partnership. This can help you avoid double taxation because taxes are done on an individual's personal taxes, avoiding corporate tax. Now, if you have a business established, especially in Georgia, when you're paying state taxes, they give you the option, because even with state taxes, you have to pay corporate taxes. And we're going to go into how the tax schedule work, okay? So when you go into the database, they'll say, hey, you have to report quarterly. You have to report yearly. And what that goes to say, you would have to report your corporate taxes and your income taxes if you are a C Corp or S Corp. Okay. Now, a lot of this is good for you to see visually. A lot of this information is for people who are actively actually doing this, because you're going to be able to visualize this information. But it is good for people who are not going through it right now, who want to kind of get an idea, who are very good with taking detailed information. So when you're ready to move forward and make the decision of how you're going to structurize your business correctly, based on the industry, and based on the filing requirements, this video should help you, okay? So because taxes are done on the individual personal taxes, they can avoid the corporate taxes, as we talked about. QBI deductions, aka qualified business income. deductions. Okay. In 2017, the Tax Cut and Job Act was passed to create a qualified business income deduction taxation plan. This allow LLC, sole proprietorships, partnerships, and corporation businesses to claim a tax deduction. So at one point, they couldn't claim certain tax deductions or even tax deductions. So this is just the law that allow businesses and corporations to um, have qualified business deductions, and we're going to get into what they are, some of them. Now, that can be, and these qualified business tax deduction can be up to 20% of their qualified business income. Okay. So out of the 100% of your business income, you can deduct at least 20%. But they have standard deductions that apply um, as well to your taxes. So if you actually report on your personal taxes, the standard deduction applies to your personal taxes. That's going to help you. Then you get the deductions of your business deductions. So it really help you save money on taxes. Okay. So LLC tax benefit liability overview continue. Okay. So business deduction. Creating a standard LLC can allow the owner to write off several expenses for the business. This can help lower the amount that they owe on their income taxes, and those deductions will be balanced off of that business income. Okay? Understanding business deductions continue. Business deductions are based on how the LLC choose to classify their business and be taxed. Example, corporations, we're going to keep highlighting. Double tax are claimed on a business level, and pass through tax deductions are claimed on a personal level. So let me give you an example. If you are owner of a corporation, you have to pay the total amount of income for that year for the corporation, federal and state. But then if you receive income and or dividends and have shares that you receive monies off of, you have to pay separate taxes on that, and that's where they say it's double taxation. Does that make sense, guys? All right. Liabilities overview. So these are liabilities that you want to keep in mind as far as your position in business. Okay, understanding what liabilities are. Liabilities is the financial debt obligation that a company faced throughout the course of their business. Okay. Personal liabilities, we know that what that is. That is the business owner's personal assets, such as houses, cars, savings, which can be utilized to satisfy the business debt. We did say that if you have personal debt, that personal debt should not be able to go into your business and extract money from your business under many cases, but I'm saying it should not because the law is changing so much and so many new cases are coming. You never know. Okay. So just keep that in mind. But usually, if you're personally being sought after, they can't go after your business assets. But if they're going after your business assets and your business asset is exhausted and it's something gross or harmful, they can actually go after your personal assets. Does that make sense? Now, liabilities overview continue. Limited liability. Businesses do have a limited liability as to what I just explained to you. Business owner financial liability is limited to a fixed rate. So even if they come after you personally, they can't take 100% of your money. You still have to be functionable. You still have to be able to run your business and your household. So they at some points they won't be able to take more than 25% of your income, these type of things. So this is depends on the judge and the court that you're in. This is most valued on a person's investment into the company and partnership as well. So if you are have a smaller percentage in the actual ownership of the business, you're definitely not going to be paying more than the person who have 80% ownership. So that's going to differentiate the liability. Does that make sense? Okay. Now, if the company is sued and it's a limited liability company, as I explained, persons can sue the company but cannot access the personal assets unless the corporate veil is removed. removing the corporate veil. In some cases, a court can remove the corporate veil by holding the business owner and shareholders liable for the company liability, especially if they are knowingly involved in the actions that was unconscionable for the business. And they wasn't able to collect the debt from the business. Unconscionable could be related to misconduct, wrongful doing, opening doorways for personal assets to be seized. So never think that just because you have a business that they cannot touch your personal assets. Depending on how gross and what is your level of liability, they can come after it. I.e., I always give you an example, doctors, that's why they have such high health insurance, and other industries as well. Okay. So we're gonna go into a little short chart, and I'm going to tell you all of most of this information is from the IRS website. So we're going to give you some links there, but everything is kind of put in my own words. You know what I do. I can't help it. Paraphrase, I don't want to take things verbatim, but this is from the IRS website. I did a lot of research for you guys. So business types, when I go into business types, is business separate from the ownership? As we just talked about, taxation, what type of taxation to expect? Just an overview of sole proprietorship, general partnership, corporations, and the tax forms. Now, you can go. I'm gonna read the tax forms. I don't want y'all to be overwhelmed about it. Just press rewind. The information will be here. Now, sole proprietorship, is the business separate from the ownership? No, you are liable. You are very liable, but they will go after the business aspect as assets first, okay? And depending on the business of what it is, um, you may need definitely help insurance, because especially in like healthcare, babysitting, these type of things, owning property, always have insurance. Taxation, what to expect with sole proprietorship, income and loss reporting by owner. You're going to be basically taxed on the income, and then the loss reporting is going to help you lower the tax liability on that income. So the more that you can basically get deductibles, or in their truthful deductibles, you can balance out the income and lower your tax that you owe. And that's done on a basic Schedule C, as I told you, or Schedule C Easy 1040 form. These forms are literally, if you use, and I don't have any type of shares or any connection to TurboTax, but I love them. They will really help you go through this. You can save yourself a headache. And the reason why I do recommend people learn how to do this, because there are a lot of scam artists out there. There's a lot of people that are promising things under the sun, saying, yeah, I can get you thousands of dollars, this, that, and the third, and come to find out, they're literally just putting and crunching numbers inside of your particular tax return, getting you in trouble. And some people even went through them getting their money kept by some of these tax people. So it's always good, like I said, to do your due diligence, or at least understand what's going on. So when you look at the numbers and you see them just putting anything in, you're like, no, no, no. So general partnership as well, you're going to have, is the liability separate? No. You and the owner, you and your partner have equal or whatever amount of partnership agreement liability with that company. Um, Taxation is based on the income again, and the loss reported by the owner. The forms that they will use, each partner, is the 1065 form. This is how they find out if people are messing up, lying. You might as well do your taxes together, because if you report one thing and your partner reports another thing, then that's where you're going to get audited. Okay. And as well as the 1040 form, where you're going to report the individual income and then the deductions. That follow. That was fast. So going into general partnership, again, we talked about that. Now let's move on to little limited liability LLCs. This is where people love it. Is the liability separate from the person? Yes, to some extent, to a good extent. Okay, but there's still a way that they could come after you. Okay, just for instance, I have an LLC. In my nursing practice, as far as some of the outside work I do, when I want to come in as a 1099, but I have my own insurance. But if that insurance doesn't cover the gross or gross negligence on my part, they can still come after some sort of income of mine if it's that bad. So understand limited liability does have some type of cloak, but depend on your industry and your licensee requirements, especially if the industry comes with a license certification, it's more strict. So that liability can still fall on you a little bit. Does it make sense? So you're going to be basically taxed on the loss report by the owner, limited liability. Again, they do have, you can report your losses, but limited liability company, that is not too much considered. The only time it's considered when I'm going to tell you if they're going to determine if you have actual business or a hobby. And we're going to get into that soon, okay? So the form you will use is 1120, corporate income tax return, limited liability. Oh, I do apologize. That's supposed to be at the next one. The form for corporate is for the next slide. So position. So I do apologize. So let's get into C corporation. Do you have some sort of cloak? Yes. Yes, corporations do have a sort of cloak, especially if you're a shareholder. You are not the first line to get sued. If you are part of the board, you're not the first to get sued. If you're a trustee, you're not the first to get sued. It's the actual business and its assets. That's why when it comes to taxation, the taxation is done separately. A corporation taxes is to be done separately, not on the individual owner taxes. What the individual who own the corporation will actually report on their taxes, this is where the double taxation come. They will report any share that they receive, interest, bonus, income, like that. Does that make sense? So do we add in a corporation type of business? Double taxation is done by that. Is it a corporate veil? Yes, because that entity is completely separate. So it's going to go after that corporation and dissolve it. And I haven't found a particular situation where they went after board members, shareholders, unless it was like, I don't know, like gross. I haven't seen that. Okay. So as we know, as a limited liability company, you can opt to be a C Corp or S Corp as well, partnership as well. Um, yeah, partnerships you can do C Corp, S Corp, because that corporation can have two big partners or it can have a single partner. So the S corp is another elective position. Does that make sense? So basically, you have an individual owner. You could be, or you can have a partnership. That's the second option. Or you can have a limited liability company, which involves yourself, and it can involve others. You can have more than one person involved in a limited liability company. Okay, but if you wanted to be considered a corporation for different tax purposes, as well as people use corporations because it's easier for them to actually um, receive donation, corporate funding, that type of stuff. It puts you in a different bracket, but you still have to have the paperwork to back it up. And that's why I wanted to highlight when you elect to be an S corp or C corp, you can't just do that just before tax season and be like, hey, yeah, I want to get some tax breaks, because they do get some, but they get double taxed. And if you don't have all your paperwork together as far as shareholders, minutes, who is the CEO, how was he elected, these are things they want to see. The IRS is your boss when you're a corporation or S corps. Okay, so people who are looking into doing that, keep that in mind. That also those S corps and C corps are actually similar to nonprofit organization when it comes to reporting. Okay, let me see something. I don't know. I hope everything is going well with this live. It looks like the screen is not moving. Hold on, guys. Could you? Oh, yeah, the screen is moving. What's wrong with my thing? Is it? Hey, God, it looked like the screen wasn't moving. Give me 1 second. Yeah, it looked like the screen wasn't moving for some apparent reason. Um, we're gonna see if it's moving now. It doesn't look like it. Hold on, guys. Now I see what happened. Because I was breaking things down, and we about how many minutes into this thing? I apologize. I know y'all wanted to see the screen too. That is so weird. Can y'all see the screen? Give me 1 second, y'all. I was noticing that it looked like it wasn't changing, but I don't know why it wasn't changing. So I think it got a problem. I think it got a problem. Hold on, y'all, because I think it want me to share it a different way. Give me 1 second. I was wondering what was going on. Anytime that y'all see that it's not moving or anything, just let me know, because y'all know I was making my way around town. Let me just make sure everything is good, and I'm gonna put on the screen a different way. But the only reason why I don't do that, you see how it's showing now, but it's not showing. Once I get off the screen, it's not showing. It's acting weird to me. Okay, hold on, guys. Mm-mm-mm. Well, I hope you guys were taking notes, and then yeah, I get to see the rest of the PowerPoint, because I'm definitely not starting over. It was like 20 minutes and 29 minutes. All right, bear with me. Okay. So that was the PowerPoint. I do apologize, it was not showing for some apparent reason. I don't like it in this mode because it's smaller for me, and I like to be able to see it a little bit bigger. But we're just gonna move through. We're on slide 9. Well, we was on slide 10, and that's where we're breaking down. This was the beginning information anyway, so that works out great anyway. So I do apologize that it was not flipping through. I think we are on better terms right now, aren't we? Let's see. Just having a little issue today, huh? Okay. There we go. All right, so let's get back to it. We're going to move forward because we still have about 20 more slides, and that was actually the beginning still. So let's talk about hobbies versus business. There is a particular point in your business where the IRS will want to determine if this is a business or an actual hobby. The IRS looks at your business as a hobby if there is no income or a loss of income over 3 to 4 years. Yes, guys, the IRS wants to see the business is making profit. People who engage in hobbies do not make profit. If this is perceived by the IRS, they may consider your business a hobby after a certain amount of years of not making a profit. Okay. The IRS have 9 considerations to determine if your business is a hobby. See IRS website for details. I'm going to be leaving that link down there for you. And this is something that you want to really pay attention to. So I'm not saying don't establish your business, but at least try to see if you're going to make some money first, and maybe the first 6, 7 months to see what type of entity you want to establish, what you need to, and would it be considered a hobby after a while. So you want to kind of make sure you're getting some income in. Okay. Now, hobby. If your business is considered a hobby, you still are allowed hobby deductions. Okay. See, these deductions can include necessary hobby expenses, that are common to the activity. This is the same concept as if you have deduction for school and those type of things, okay? The government will give you some type of discount. The limit is that you can only claim as much deductions not exceeding the value of the hobby income. So this is going to be very different from a basic business deduction. Hobby losses in income cannot be deducted from the taxpayer income. So if you lose money, that money that you're using on a particular hobby, it cannot be deducted from your income, okay? And but if it's from your business, that can be deducted from your income. Okay, because that's part of your income. That's what is considered your income. Does that make sense? Now, taxpayer can itemize their deductions based on their hobby expenses. Hobby deductions. So fall under three categories, which are special rules that apply to IRS publication 535. I want you to go on the website and look. If you got a hobby, your kids got a hobby, and you're paying for it, you may be able to use it as a tax deduction, okay? Or you got them new college students that's doing hobbies, they can do that as well. Okay, highlighting the rules about claiming itemized deduction for hobbies. That's going to have the information for you there. What should I file? As a business owner, you should file federal taxes and state taxes. Let's get into it a little bit more. Federal taxes should be filed for a small business that receive income and or employ people. Keeping in mind that the company structure and the location of the business plays a part, can affect the taxes and liabilities. In some cases, business can be liable for self-employment taxes and excess taxes. Excess taxes is something we're going to talk about. That's dealing with the tobacco and alcohol company, companies like that. They have a various amount of different taxes. And then based on jurisdiction tax differently. Okay. What should I file? Again, federal taxes and state taxes. Get into state taxes. Income. Under state taxes, they're going to be taxing income and employment taxes the same way they're going to be doing on federal taxes. The income, this is the pay that applies to earn income from the business. The earned income can come from projects, ventures, employment, investment, other sources. Anything considered income. This also applies to the C corporation. When paying on its profits as well. Okay. Employment taxes. It is mandatory that business that pays employment taxes. It is done if the business have employees. That's when you're going to be paying employment taxes or withholding employment taxes to submit to the government. This tax withholdings come from the employment gross pay. That's the same thing in consideration when you're selling goods. When you're selling goods, those goods have taxes and services. So you will collect that and submit that on a state level. And that's the same thing here. But the difference is with employment tax, they're collecting it for these purposes, which is Social Security and Medicaid or Medicare. And also Medicaid. Yeah, Medicaid. So Social Security and Medicaid are required to be held by the employer. So this is something you need to keep in mind if you are a business owner and you're planning on having employees. That's why a lot of people contract at this point, so they don't have to give them benefits. But you still have to take taxes out, depending, because I contract as a nurse, but they take taxes a certain percent portion of the money. But regardless, taxes still have to be held, or if not, it has to be reported. What should I file? Now, federal and state taxes continue. Self-employment taxes. If you pay yourself, you do have to file that, guys. Now, yes, I am going to give you everything so you can know what to do and what you don't have to do. Okay. So you would have to file self-employment taxes if you pay yourself. Self-employment taxes due when the individual who owns the sole proprietorship, who, if you own yourself and pay themselves, some employment tax can vary, and the rate of self-employment tax can be up to 15%. That's the same thing like you're paying an employee. You're going to be paying Medicaid and Social Security. So Social Security is at or about 12%. These are abstract numbers, but I'm very close. 3% is Medicare at this point. So that's why they hold 15% of our actual taxes. I was about to get sidetracked, but I'm not. Okay. So excess taxes. Excess taxes can apply to retail, I do apologize, transactions that are related to certain goods and services. Remember, excess taxes, what I was talking about now, this is where it applies. There are complex rules that may apply to these taxes. These taxes can be related to alcohol, tobacco, and other goods such as fuel. So, if you're in that industry, you really want to be well rounded about what is the regulations, what is the tax requirements as well, what you're going to have to pay because it's remarkably different. They have their own guidelines. These type of taxes are also extended to or companies who does gas extraction, indoor training centers, aircraft management, and several other categories. So this information can be reviewed on the IRS website to see if your industry fall under there. Okay. State and local taxes continue. So the income tax, when it comes to state taxes, that's what we're looking at. State and local taxes. Local taxes and state taxes is not on every state. Okay. I think Florida don't have state taxes, right? Right? Correct me if I'm wrong. Now, income taxes are in about 43 states that impose their own income tax. Okay. Please see states for detail. These taxpayers must submit additional to federal taxes. Okay. So in Florida, I think it's just federal taxes in Florida. Correct me if I'm wrong, right, guys? State charge additional income taxes that can be added to a corporation as well. So the corporation be double and triple tax in these particular, and sometimes quadruple because certain counties charge their own taxes. Like Atlanta, in Atlanta, it's like an extra tax in Atlanta, and you be like, what? Atlanta taxes? Yes. So please be aware of that. In particular areas, they do that, and Atlanta just charge you for anything. If you like gratuity is already on the check. Okay. Atlanta is just very weird. They want the money. That's not weird. Now, moving forward, employment taxes. When state and local tax apply, when these state and local tax apply, the jurisdiction where the business is located, that impose the taxes. Does that make sense? So, like I said, Atlanta's going to impose those taxes. Owners must withhold and report taxable income paid to employees, as I mentioned to you. So you're going to hold that money, you're going to send it to the state. You already deducted out of their pay. There are some states that has a reciprocatory. There are some states that have a reciprocatory agreement that cover multi-state employment situations. This will ensure that the individual taxpayer do not pay double taxes levels on their income. Now, this let me give you an example. When I worked in New York for the COVID, and I was in Jersey, and I lived out here, I that percentage of money that I made was not included on the total amount that Georgia was charging me taxes on. So let me give you an example. If I made $150,000 totally from both states, and $50,000 was in New York and $100,000 was in Georgia. That means that their reciprocatory agreement means that Georgia would only charge me $100,000 tax on that, and $50,000 would be taxed from New York. It wouldn't be the total $150,000 from New York and Georgia. The total $150,000 tax though would be on a federal level. Does that make sense? So when you're working multi states, you want to keep that in mind, especially if you're doing your own tax. Don't cheat yourself, okay? Now, please bear with me because I don't have the big one on. I'm going to put my glasses on because it's small on the screen. So, what should I file? State and local taxes continue. Now, state and local tax can also charge taxes based on the property taxes. The location where the property is located, where official business is conducted, can be subjected to property taxes. This is if the business is done through an individual personal home or property. Okay. Um, Let me give you an example. If you are doing a particular business in your home, that county can choose to increase your taxes because you're doing a business and personal use for that property. Does that make sense? This is where the tax liability may change. But that's only if you have like greedy townships. But there's some that's really like that. So they're going to charge you as a business and a percentage, like a portion is going to be charged as business taxes on a property and a portion is going to be charged as personal property because you live there. Does that make sense? Like someone who has a dental office out on the first level of their home. The first level of their home will be taxed business wise, and the rest of the home will be deductible for their personal. Okay, the taxes that they pay on that. Well, they'll pay taxes on that portion, and then the deductible will be based on those percentage. Does that make sense? All right, so let's keep moving. The IRS allows the business deductions to be done on the same portions of the personal home owner's property taxes for their federal tax liability. That's what I just explained to you. You'll be able to claim deductions on both levels. It's just the percentage if you're going to be using your personal property. Sale taxes. Now, if you're a person who's selling goods and services, there are about 45 states that impose sale taxes on retail transaction. These retail transactions fall under many different classifications, but focus on goods and services. Businesses are responsible to pay these taxes and follow complex rules. Depending on the industry, please keep in mind because there is a large room boom, I do apologize, on online businesses. There can be applicable taxes and new regulations that lawmakers are making as new technology come and new processes come. So let's keep that in mind, okay? It's a growing age of AI. They're gonna have to file away the taxes and they're gonna do it. Okay, so we making our way. We about halfway through, guys. I told you it's going to be pretty a long presentation, and I do apologize for the first 20 minutes because I did not know the PowerPoint was not moving forward like it's supposed to. Now, what are types of business pay? What are the type of taxes business pay? Okay, we're just going to do a little review of that so you'll know. It is income taxes again, sale taxes, property taxes, payroll taxes, self employment taxes, and excess taxes. That's just what we went over, okay? When do I need to file small business taxes? Okay. Now, this is what I want you to understand terminology. Companies report periods can fall under 3 periods to file their taxes. This is known by the IRS as tax years. So they ask you, what's your tax year? You be like, January. No, not always like that. A calendar tax year is the basic. A calendar tax year is based on account periods over 12 months, starting at January 1st and then December 31st. Okay. Fiscal tax year. If they say what's the fiscal tax year, that's pretty probably because of this particular situation. The fiscal tax year is a 12-month consecutive period that ends on a fiscal day of any month but December, meaning that you may have started your business in May. So your fiscal year is going to be from May to April 31st of that end of that. You know what I'm saying? Before that next May comes. Does that make sense? So that'd be the fiscal year. Calendar year. Short tax year. A short tax year covers an account that there are less than 12 months. This can happen when a company starts in the middle of the year or change its form within the calendar fiscal year. So these are the terminologies that you need to know when you're talking to tax personnel about your actual information, your tax status. Okay, they're gonna be like, what's the fiscal year? When did it start? When did it end? You don't want to be confused. When do I need to file small business tax? So quarterly estimate tax is usually what's recommended, and it's the norm. According to the IRS, personal income taxes are due on April 15, excluding if exceptions are made on a yearly basis. They give extents April to some. My chain came off into May. Okay. Businesses, our taxes are quarterly, meaning that you don't do it every year. You do it quarterly, and it depends on how they're seeing your income. They may change it for you. So business taxes are quarterly. Quarterly taxes are considered paid as you go system. According to the IRS, this quarterly PIC report system specify reporting requirements, so they will monitor how much you're making. If you're not making $5,000 a month, they may say report every 3 months and pay estimated tax then. If you don't make that much, they're like, well, do it yearly the next year because we want to see what happens. So it will change. If also giving the IRS a closer look on the business, revenue losses and gains, or a shorter time period. So basically, I do apologize because that was a typo. If there is a shorter time period, that means that you're making more money. And they want to make sure that you're documenting this correctly as well as reporting correctly. And it's more safer for you to do that because if you have a lot of like 1,000 transactions in 30 days, it's better for you to shorten your time of, running your books, make sure your account is right, and making sure that the adjusted or estimated tax are paid. So by the end of the year, you don't get caught up because a lot of people make all of these sales and then they don't pay the taxes quarterly and then end up spending the money and they don't have the money to pay the taxes at the end. Does that make sense? This is why they break it down like that. It's not just because they want to just, well, they do just want to collect your taxes, but you know. When do I need to file small business tax? The quarterly estimate tax, okay? These estimate taxes based on what the company report in these quarters. Example, quarterly estimate tax can be based on income between a period of time, January 1st to March 31st in that year. It can be April 1st to May 1st, May 31st, where you report right at the end. Like after March 31st, I made $5,000. You're going to pay taxes on that. At the end of May 31st, I made $2,500. You're going to pay on that. At the end of August 31st, I made $50,000. You're going to pay on that. Okay. At the end of the year, then between September and December, that last little quarter, you made $20,000. Okay. So in the end, you're able to add all of that up. How much we said? About 75,700, $500 you made over the year. Good. You made money. Okay, made some good money, huh? Okay, so that's how you would keep track of it. You see how I was able to break that down fast just because it was broken to quarters. So that's what the IRS is thinking. And as a business owner, that's what you should be thinking to make your books easier. Okay. Each payment deadline has about 15 days grace period to pay the estimated tax. Usually, as I mentioned earlier in the broadcast, this is done on a website. Georgia State tax reporting website. And there, that's where you're going to pay. You're going to report your sales, what county you were in, and how much you're going to pay there. That's on the state level, though. Federal, you might as well just save the money in the account because the Fed's going to catch you once a year. Okay? Once a year, unless you're a corporation and you have all of those reporting requirements. Does that make sense? All right, so what we were just talking about, the importance of good record keeping, there is an important reason why. All the stuff that I just said. Why should I keep good records? Good records keep you good records keeping is helps you monitor not only the taxes that you may pay, but the progress of your business. Preparing financial statements help you identify income sources, track deductibles from expenses. You want to get the deductibles down, especially if it's more than a standard, you know. Also help you adjust your business spending accordingly. If you're seeing you spending too much on this product, this is something you could catch in a quarter. Instead of you waiting 6 months to do your books again, you're doing it every 3 months. Oh my God, I'm spending too much on potatoes. Okay. Keep record and review time on a short-term basis. Some such as every 3 months, as I just mentioned, or doing a monthly review of your business records. It's important, especially if you have a partner. Y'all supposed to be on the same page. Y'all meet every 30 days. Y'all meet even every week. It depends on how value your project is, your venture is, your business is. The more high value, the more meetings you make, the more sales you make, the more y'all gonna, keep books, be on point, okay? Now, what kind of records should I keep? Records that you keep can be online or paper. Me, I like both, but I really like paper. I like online access, and I like to be able to print it out and keep it forever. Okay, because sometimes you never know what's going to happen with the internet. So always try to keep paper backup on important things. It is important to decide which is best based for your business entity organizational process. A lot is good to be done online, but in still some things you need to keep copies of, okay, especially originals. Keep your records such as your income and expenses. If you don't keep anything, you want to keep what money you coming in and what's going out. Also, this is the most important set of documents to keep. Business contracts and agreements is important to monitor and adjust accordingly. They can save you money. Maybe you're on a monthly contract with somebody and you see they're charging too much for their particular material that you're using, and you got another vendor. You just notice that, like, hey, this man is deducting 3,000 every month and I can get this for 2,200. I can save $800. You want to look at your records all the time. It's not just for tax purposes. You want to be able to save and get a bang for your buck. Keep looking at the change of market and being on it so you can be able to utilize it for your benefit. Okay. How long should I keep my records? Now, I think this applies to most industries. Me, myself, as a nurse, I keep my stuff for about 4, 5 years. If the judge called me, I'm going to have my papers and I'm going to at least try to remember something. So, this is the same concept that I keep with most, especially my financial documents and contracts. How long should you keep it? The length of time you can keep a particular record depends on the action of the record and the expense. A hot water heater you bought for your house, you definitely want to keep track of that. You spend $10,000 a gate, you definitely. If you just put plaster on the wall, that may be something you don't keep. You're not going to stress, but those big expensive, you keep that. Okay. Records are kept to prove transactions, income, and other expenses. This is what you're keeping it for your proof, for your memory. Relates to deductibles on tax returns. You want to get as many deductions as possible. I know we have standard deductions. Our standard deductions has been great. This year's about 18,000. Last year's about 16 or 17,000. Thank you. It went up a little bit. But if you spent way more than that in your business and your income for your business was $50,000 and they only give an $18,000 tax deductible and you spend $35,000, you want to get $35,000 in deductible. You want to do your best. So itemize, itemize, itemize. Okay. I hope this information is doing you good. And again, I hope this is great information that you can use for this year, next year taxes, just getting a foundation of how to file business taxes, what to know. Okay. What is the burden of proof? Exactly what we were just talking about. You know me, do your due diligence, have your proof already ready. When it's time, you're like, boom, 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 boom. You don't need to look for nothing because you got your papers together. Don't ask me no questions, okay? I'm just playing. The burden of proof is the responsibility that a person or entity that may have to substantiate their deductions and income that is reported to the IRS, as well as if you have nonprofit organization, people are questioning the spending, like the board or the trustees, things like that. You want to have that paperwork ready. Okay. In some cases, when businesses or entities are audited, this is when you want that paperwork ready. My mother is the queen of audits. When we were in Jersey, this is one of the reasons why I got so efficient as a HR director in a nursing home. My mother, I used to be the secretary, okay, but I was the secretary to about 7 departments in the nursing home. And when they got ordered by the state, when OSHA was there, Oh, I was retrieving paperwork. I was making sure the files was together. So I knew the importance of organization, timekeeping, management, where to find timely files. They wanted files from 2020. I mean, 2003, and we was in 2013. We like, oh my God. But it was good because we had good record keeping. Okay. Even archives. Because what they did with the archives was transfer it to a warehouse that they had to. They had a big nursing home. So just giving you an example. So what is the burden of proof? The burden of proof is the responsibility that a person or entity that may have to sustain their deductibles and income that is reported on the IRS website. Okay. In some cases, when businesses or entities are audited, these documents are needed to prove the filing validity. How long should I keep the record? According to the IRS, it is recommended to keep all records for at least 4 years. Okay. I ain't playing. I keep them for 5, possibly. I got little banker boxes. Play with me and say I ain't pay a bill. Play with me. Okay. How to determine your tax rate. A tax rate determined by a set rate. Okay. The tax rate is determined by a set rate. And this set rate is determined by the status of your business entity and the current IRS code. So tax rate for products and goods such as alcohol. Tax rate could be 5% today. This year, next year could be 4%. This is what you mean by tax rate. Tax rate for the local county is 5%. Next year could be 7. Tax rate. Does that make sense? Be it a corporation, LLC, or partnership. This is how they determine your taxes based on tax rates, okay, for the year, just like interest rates. How do you determine your tax rate? So you're gonna go to the IRS website, state website, kind of get an idea what the taxes is. But you want to use that particular number, and you want to determine that based on your income. So let's go. Percentage of income. Corporate is at or at least 21%. So 21% of your income, federally and state level, corporate tax can vary. Okay, so you want to keep that in mind. If you make $100,000, put away 21%. Put it in a savings account because you may owe that or a little bit less of that amount to the IRS. Do you understand? Okay. So you want to know the tax rate for whatever you're selling, whatever you're buying, whatever your entity is. So you don't get caught in the end where you spend all of your profit and then you didn't report properly and now you got this big issue. We're sharing this information so you can secure your energy and be a great business owner. We want you to win, guys. Okay. So partnerships and LLC usually do not pay no taxes at a entry level, and that's basically corporate taxes. You're going to be doing a pay as you go. And also you're going to be paying through your personal taxes. Okay. So the pay as you go is the reporting system on a state level, and then you're going to be paying on your taxes. But they are required to pay taxes more personal income obtained from businesses at about 37%. Now, so for instance, you have your money that's coming in from your business, but then you pay yourself. Just know that you can be taxed up to 37% on that income. That's why people do certain things where they just, for instance, they'll buy what they need to make their business functionable. Like me, I'm a content creator. So if I want to, I can have a budget for clothes. Not a lot, but that could be considered. Does that make sense? So instead of me paying myself more money or paying myself money, I could just actually use the business money correctly and subsidiate some of the income that you would want to pay yourself because you will have to pay taxes on that. Does that make sense? And if you actually buy a wardrobe for your particular industry, and I'm gonna say like electric man, you got to buy stuff outside like electric clothes. But you see what I'm saying? That's where a write-off could happen. That's where you can balance out some of these taxes. It just the taxes are high, y'all. If they ain't catching us one way, they're catching us another. But if you understand it, you're gonna be able to maneuver around. And that's why we're talking about it. Okay. It's hard to hear that we paid somebody 37% when they didn't do the job with us. It's hard, but we just got to do it unless you're going to tax jail, unless you know how to debate it. Okay. Don't let me go to the left. Okay. There was an IRS agent that said taxes wasn't real. Don't let me get distracted. All right. So, self-employment tax rate is about 15% and up applies to Social Security and Medicaid, Medicare. Okay. And that's if you're paying an employee, not yourself. Okay. Now, how to determine your tax rate continue. We're coming towards the end of the PowerPoint. We did good. Okay. I do apologize for the hiccup at the beginning. The way I was sharing it, I always share it like that, but I don't understand why it wasn't letting me click through. But you get to see the bulk of the information, which was the most important part. That first part was actually the flashback. Now, so how to determine your taxes? Percentage of growth sell. Okay, the gross and sell. This type of taxation is based on the revenue that came in from your business. Okay, this money or income can stem from goods and services or whether other means of profit. This is what we talk about already. That's how you determine your tax rate based on the income. We already told you what they taxing. Just the other way of us saying it. We saying it two ways. They tax on that. That's what you got to pay now. Do you understand how to determine it and what they tax? We're literally saying the same thing. Keep in mind, sales taxes vary from, I'm smiling because it says sell, like CELL. Sales taxes vary from state to state, and some countries also require you to charge, some counties, I do apologize, also require you to charge sale taxes. And that is, for example, Atlanta, I'm in Henry County. They make you charge sale taxes for the county. Some tax rate can be as high as 10%. Atlanta was up to like 12 or 7. It was something ridiculous. So you're paying the state, no, you're paying the federal tax, whatever, when you go buy something on the goods, and then you're gonna be paying taxes to the county. You're gonna pay close to 30% on something. It's just ridiculous and mandatory gratuity. But I'm gonna move forward. Now, percentage of wages is a thing that you want to keep in mind. We said it the other way, but now we're going to say it this way. How you determine if you own a company that employs people, it is your responsibility to pay the taxes on the wages earned for the employee. Your responsibility. This amount of taxes is only based on a certain amount of the income. It depends on the particular position. Like I said, when I travel, when we're traveling contracts, when we're out of state, we get a stipend. If we're over 50 miles, and the state knows that, so we get this bonus stipend. They cannot charge us taxes on that, but they can tax on our actual salary. So what will happen is that our salary be a little low. Shut up. Lower salary, more bonus. Okay. But nurses don't know that. I'm a hustler. I'll be like, what's the pay rate? Put it a little lower. Give me a more bonus. Okay. You know what I'm saying? Okay. But you don't want your pay rate to be so low, because when it comes to you finance and refinance and getting loans, if your gross income for the year is low, it's gonna make it hard for you to borrow sometimes, especially if they're asking for your W-2. Okay. Not your W-2, they're asking for your taxes. Okay. So you're gonna want to know that percentage on wages is tax, property value tax. So you want to know about that, and also it's gonna help you determine your deductions, because as I mentioned to you, you can have a house and you're working in one particular area in that house, and it may constitute of 35% of the house. You're gonna get 35% of that deduction of what 100% of the house deduction would be. So if the 100% deduction of the house would have gave you $800, and you can only do 10% of it, you get $80 of the. I don't know. Did I say it right? Yeah, I think that's about right. $80. You'll get $80, okay, of a deduction. But I'm just kind of throwing that out there. So if you own the property that you have sold, you may have to pay a tax rate on $1 per 100,000. $1,000. So that's when you sell property. And so you gotta understand the tax liability in that. That's just kind of sneak peek, because we're gonna get into estate taxes, I think, the end of next week. And that's something that you want to understand when we're dealing with property value tax per dollar, and that's dealing with estate taxes. Okay. All right. So, business expenses and deductions. Dun 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 dun. Getting towards the end, and I think that we're gonna have to log off of YouTube. I mean, well, we're gonna have to log off of Instagram soon, but we're gonna see can we make it through. Business expenses and deductions. Business expenses. To get a better understanding of business expenses, please see the resources provided at the end of this presentation. We will share IRS links to get official resources to you guys. Okay, that's what we do. Business deductions and credits. These deductions can reduce tax obligation for the business. As we explained, the owner of the business are allowed to deduct or subtract the cost of the expenses from the taxable profit or income. If you made 800,000 in profit, you want to write off as much as possible. If the standard deduction does not meet that or exceed that, then you better do an itemized deduction. Okay, try to get save as much on how income you made and that balance off with how much you spent. These deductions are applicable to all profit companies operating in the United States, but they have standard deductions. They have credits that they give depending on what's going on in the country, home credits, all types of stuff. So that's going to help you when it comes to you doing your taxes. So let's just get in a few of these deductions. Expenses and deductions, what they are. Again, this is just a highlight and a reiteration of everything that we talked about today when it comes to business expenses and understanding what you can use as deductions. So these expenses can be used as deductions. Employee pay, well, you can't use that for a deduction. That's just an expense. Rent and mortgage expense, that can be helped used as a deduction. Interest paid, that's an expense, can be used a certain part of deduction. Taxes paid as well. Insurance paid. Bad business debts, depends. It depends. Okay. Advertisements. Now, this is just a little bit because there's a lot of business expenses that can be deductions. Banking charges, cell phone and internet, equipment and rental, paying contractors, personal fees, legal fees, professional fees, I do apologize, and legal fees, licenses, utilities, and more. Okay? So, these are some of the resources that we have for you today. The IRS starting a business link. We're going to put this at the bottom. Operating a business tax credits. This is something that you should look at before you actually start a business, or if you already started and you about to do your taxes or you're doing it. These are things that you want to have idea. You want to have a great idea, and this is a resource. Also, a guide to starting a small business. Did I do that twice? Oh no, okay. This is another one. A guide to starting a small business. This is also from the IRS website. Yeah, other one is from the IRS website for small businesses. It's two different ones. One is a PDF and one is actually a web page. And closing a business. It is very important, guys. If you started a business and you are not operating it, you must close it. The IRS is going to still think that your company is active, and then they're going to seek information from you. Then you're going to have to prove that the company was actually closed and you weren't in operation. Can be simple, can be complicated, but that's something that you want to know how to do. So that link right there for you is going to share that. And I think that's what I have for you today. It's been a pretty long broadcast, as I knew it would be. We were going to be here for at least an hour. Again, the first portion, the first 30 minutes, literally is a flashback review. So don't feel away if you did not see me click through because it was paused. But when I noticed it, I made sure that we were able to get the PowerPoint up there for you guys. Okay. This particular broadcast is going to be here for February. Okay. So this is part of our Secure Your Energy session for people who want to secure your energy and creating business, understanding how to maneuver in commerce, protecting yourself from scammers. We're actually going to go into a little bit of that Monday. I said, oh, I was going to do a fun topic today, but I said, no, let me just get this out the way because as I got to the end of this, I noticed that I had to do a part 3. Okay. So I think next Friday we're going to follow up with the part 3, which is the last part. We're going to go into a detailed review of estate taxes, as well as hold on, that particular broadcast. We're going to go into estate taxes, tax deferral, tax investments. What should you know about tax deferral accounts? Tax benefits when you have these deferral accounts. A whole lot of other stuff. Real estate investment trust. We're going to give you a little brief synopsis of that. And just some financial instruments that you should be aware of when you're investing in real estate and you're trying to defer your taxes. The only way you defer taxes is if you put that into another project, a certain percentage of that profit into another home, into a deferred savings. So that is part 3, where we're going to go into estate taxes. We're going to go into a few more of these extra investment avenues, these different investment avenues that you can use to help you defer taxes, how some of that money to when you're ready to reinvest it in those particular things. And that's going to actually close off the little series we were doing about understanding taxes for business owners. So I hope this live proved you beneficial. Monday, we're going to be doing a trending topics like a market watch. We're going to be doing real estate market watch. There's some things going on. Come to find out, about 45% of the property that was bought over the last 3 to 5 years were corporately bought. Okay. I'm surprised. They said 40. I think it's 60 or 70. But we're going to look at those numbers, see what they're talking about. Because when corporate runs our housing market, that means that our inflation is going to continue to go through the roof. Literally, income-wise, we cannot sustain the standard cost of living. I.e., example, the standard cost of living in Georgia right now, you at least need to make $120,000 or $70 to $120,000 for you to be comfortable. And the average income out here is about $40,000. So that's telling you that's a major problem. So when we go into Secure Your Energy Market Watch with Lashley, I do apologize, on Monday, we're going to get into that. So I want to say thank you. Please hit the like button. Please replay. I gave you a lot of information today. Yes, I know. But I want you to cross-reference it. I will also be putting the links down at the bottom. So again, have a beautiful, beautiful weekend. And I'll see you on Monday. Gotta go.
The real estate market often seems like a distant world where only an elite of experts is successful. In a time of so much uncertainty in the air and bad news, realist investing can seem intimidating. But today, I want to tell you that if you make the right decision today, you can enter the real estate market from the back door. Bad credit record? No credit at all? Do you dread the idea of having a home loan? Do you dream of owning investment properties? You are in the right place and right time, because we have created a program which is a tax lien and deed investment online course of only 14 hours. This course is specially designed for people like you who have big dreams. You will learn at your own pace and everything from your home computer. This is your chance. Join our membership for $19.99 a year. What are you waiting for? Visit our website primetimehomebuyerBuyback.org and sign up today for course access.